Hello, welcome to our webinar today with the title of Fundraising Tips and Tricks for FinTech Startups. And our webinar today is focused on our members. So welcome to all our FinTech Circle members who have joined us today. I'm very happy to have a very special guest today with me, Mallika Paulraj, a famous investor, a book author on investing as well. And today we want to dedicate this hour focused on investment tips and tricks from a startup perspective. So it's really about you, how we can help startups, CEOs, founding teams help to fundraise successfully, and how we can help you by sharing with you tips and tricks and lessons learned from others whom we have observed over the last few years, other founders, when they went on their fundraising journey, what we have seen, mistakes they made, but good things which we could observe. We want to share this in a very concise form today. So it's a hopefully very special and very valuable time to summarize those insights and help you become more effective and more successful in your own fundraising journey. So that's our goal for today. As I said, I've got Mallika Paulraj as my guest. And before, I would like to ask her to introduce herself, just a few words on myself. I'm the CEO of FINTECH Circle. My name is Susanne Chishti. Many of you know me already. I'm originally from Austria, from Vienna, came to London 22 years ago and worked most of my life in banking. So initially as a consultant, implementing software solutions for banks, then for Morgan Stanley for 7 years in London and in Hong Kong, then for Lloyds, for Deutsche Bank. And in 2014, I left banking to launch FINTECH Circle. And so in the last 5 years, we've been investing in fintech companies. We've built up FINTECH Circle to now a global ecosystem of fintech entrepreneurs, investors, lots of fintech thought leaders and experts, and we reach almost 200,000 people every day across all our social media channels as well. So we've got, from the inner circle, which I call our investor circle, to the outer circle, which is our social media reach, our distribution network focused on fintech innovation. So that's what we are doing every day. And I've got a wonderful team as well working with me, who you might already be in touch with. So it's Irina and James, whom you might have spoken to already. And we will speak about, the benefits as a member also. It's part of the Q&A. But now, before we go into the details, I would like to hand over to Mallika to introduce herself and to tell you more what Mallika has been working on over the last few years already.
Okay, thank you so much, Susanne. And I heard about you long before I met you, and I really admire what you've built up with FinTech Circle. It's such a great ecosystem, and you've done so much for the community. And thank you so much for having me on your webinar. Basically, I'm obviously of Indian origin, but I was lucky or unlucky that I grew up in this very interesting town called Palo Alto, California, because of where my parents ended up in. But it was the heart of Palo Alto is the heart of Silicon Valley. And I ended up going to Stanford, I ended up going to Palo Alto High School. So I knew a lot of these entrepreneurs and investors. And so I was immersed in that ecosystem, but as growing up and in my 20s, and I worked in Silicon Valley in the late 90s, early 2000s. So I think I have a certain cynicism towards it, but also a realistic view, I think. Basically, I trained as a quantitative person in engineering and computer science, worked in Silicon Valley doing chip programming, and then moved to it was a random sort of job offer from an old boss to New York to work for Lehman Brothers. And then I moved to London to do a master's in environmental policy. And for about 10 years, I was an ESG analyst for various hedge funds and MSCI, and basically building these ESG indexes. About 8 years ago, I was trying to help my family invest, and I realized that high net worths, that is people who have money or sell out of companies and they usually end up becoming angel investors. but they really don't know how to allocate their capital, what type of asset classes they should use, who they should go to, what all those things. So I was very motivated by this. I'm also part of the Stanford Angel Network in London, so I see a lot of deal flow through that. And also, Susanne, you've invited me to be part of your FinTech Circle judging team and coaching team, so I see deal flow through that. And obviously, because I've been in finance and tech, the FinTech makes sense for me. Basically, I went out there and I saw there's an investment education gap, and I started blogging and getting clients onto my workshops. And I ended up writing this book called How the Best Invest, Make Confident Decisions Like the Investing Superstars. So, which I think you're going to share the link. But it's really meant for people who could be potential investors to your startups. And I make it my kind of niche is getting into the minds of wealthy people, or high net worth people, and see what they're looking for. So I'm hoping that's useful to your journey.
That's excellent.
And, okay. And Susanne, why did you decide to launch FinTech Circle's Angel Network? Like, what was your motivation?
I think that's a very good question, Mallika. I mean, it started out, to be honest, when I was a student, because I was studying, similar like you, in the Silicon Valley in Berkeley. It's actually Berkeley and Stanford always was competing. Do you remember, Mallika?
Yep.
And so I was in Berkeley in the business school. And afterwards, I worked for Tandem Computers, so a fintech company would call nowadays, in Cupertino, in the Silicon Valley. And the time I was there was 95, 94. So it was the time when the internet was being invented. And it was the time when we had the first internet IPO on NASDAQ. And I remember it was an incredible time. We had in the Silicon Valley, we had the best entrepreneurs coming together with the best investors, the best venture capital funds. And best, kind of the whole innovation started literally in front of my eyes. And so 20 years later, when I was in London, 2014, 2015, when I launched FinTech Circle, I could see the same thing happening now in finance. So almost the internet revolution, which happened, 25 years ago, is now happening in finance. And at that time, 5 years ago, I thought, okay, I've saved money now working, for banks. I'm at the right time in my life, to leave my job in banking and basically start my own startup focused on fintech. And my goal was to create the best network between fintech investors and fintech entrepreneurs, because I was a member of other angel networks. And angel networks, normally in the UK, they are sector agnostic. And what this means is that if you are let's say a tech entrepreneur, a fintech entrepreneur, and you present to angel investors who do not understand technology, who do not understand finance, it feels like you talk against the wall. Because they never get what you're doing, and they will never invest because they just don't understand it, and it makes them uncomfortable. And they would not invest in something they don't understand. Equally, from an investor point of view, I was interested myself to invest in fintech companies, but the angel networks I went to wanted me to invest in shoes, in consumer products, in things I did not understand. And so it was a complete mismatch. And that's why, FinTech Circle's Angel Network only invests in fintech companies, and all our investors are only fintech investors. So that's the reason why I set it up, because I thought we need a dedicated, Angel Network which really focuses and brings both sides together.
And you've done an incredible job. So whenever I've come to one of your live events, the room is full and everyone's very pleased with the quality of on both sides. So how does a startup get involved with you? How does the application process work? And how do you select the best fintech startups for your network, for your angels?
Yeah, so the way we do that is by having an online application process as a first step. So when you go to fintechcircle.com, you will find the information for startups, how to apply to our angel network. And basically what we require are three things. One is to complete the questionnaire. So it's an online questionnaire so that it's standardized, of all applications, we can compare them easily. The secondly is your investor deck, basically your PowerPoint slide deck, how you present your business to investors. And the third is a mini video. So we call this an elevator pitch. It can be like about 3 minutes long, can be recorded on your own phone, but it's really about getting to know you or the founding team and getting to know the reason, why you launched the FinTech startup, why the founder believes in the vision, so that we get to know the elevator pitch. So based on those three things, we get then all applications coming in, across normally 3 months. So we run angel networks every quarter. So we've got over the last 3 months, we will now, and that's, by the way, our deadline is coming up end of November, for those startups who would like to apply to our investor network. It's end of November is the deadline to apply. And then again in December, we will review all applications and we review those things. We review your video, we review the questionnaire, we review the slide deck. And out of all applications, we select the top 16 companies. And these top 16 companies get invited to selection days. And these FinTech Circle selection days are run over 2 days. And you, Mallika, you know them because you're one of the judges. And we have got a group of about 6 to 10 judges with us who help us to choose the top 8 companies. So basically, after the 2 days, the 16 companies present, we cut the numbers down to the top 50%, to the top 8 startups. And these 8 startups then we invite to a so-called coaching day, which is a 1-day event where we help each startup to prepare for the investor network, prep typical questions they might get, from investors, how to best respond, how to make sure that you have the information you need. And then comes the actual investor night, which is normally, from 5 o'clock onwards. And so far we do everything online, so it's all virtual. But I do hope, after COVID is completed and the pandemic is over, so next year we can go back to having our investor evenings all in person again, because of course it's lovely to meet potential investors in person in a nice atmosphere. But that's our journey, Mallika.
Okay, so very interesting. And you've been going for 5 years, Susanne. On average, it takes about 7 years to reach your first exits for an angel investor networks. Have your investors been seeing exits yet? How's that been going?
Yeah, very important. I mean, for investors, you're right. I mean, investors want not only the money back, but they want a nice return on their investment. And the only way you can get that, as a private investor in private unlisted companies, via an exit. And you're totally right, Mallika. Normally we say it takes 7 to 10 years on average to exit a startup, because it's so early stage. But we were lucky, or maybe not just lucky, but I think we've got very good deal flow in FinTech Circle. So really the best FinTech companies apply to us for funding. So we had already 3 exits in the first 5 years, where our investors benefited very well by having been able to sell these FinTech companies to large clients. And so we had, one exit was acquired by Santander. So one FinTech company was acquired by Santander. We had one company was acquired by Legal & General, and another company was acquired by comparethemarket.com. So we had 3 fantastic FinTech entrepreneurs who did very well as well, for themselves and also for their founding teams by exiting to very good buyers.
Okay, that's excellent, Susanne. I think, the other angel investing networks don't have that kind of track record. So congratulations, especially given you're still only 5 years old. You've told us how you select your startups. Can you tell us how you select the investors into your network?
Yeah, a very good question, Mallika, because, for us, and for me personally, what I said from the beginning, because coming from financial services, there are lots of, I guess, financial experts, who don't take startup entrepreneurs seriously. There's lots of still arrogance, in finance, where people who have got the money look down on other people who don't have the money, And so I said, when I launched FinTech Circle, we have got the so-called no jerks policy, which basically means we only want nice investors who treat startups eye to eye, at the same respectful level, because at one day our startups can be the next the Facebook founders, then so the next Zuckerberg. So we said, we want only really good and nice and high quality investors. That's what we built. So the way our investors come to us is normally by referral, from other investors, or they can apply to us online as well. And then we check out, their backgrounds, their profiles, and we invite them to our investor networks normally, but they can then, see and meet all the startups they're interested in. So it's very much, normally either referral or that we can we choose, and our goal is to have the highest quality of investors. And of course, the profile of our investors is either people who work in banking. I would say lots of our investors, of course, are working in banking. That's where they have expertise from. Or people who have run their own businesses, who are basically entrepreneurs themselves, but sold their businesses and want to now not anymore run another business because they know it's exhausting, to be your own founder, but they want now to invest their money in many startups. So they want to diversify, the money they made from their own exit. So those type of investors are part of FINTECH Circle.
Okay, sounds like you've really thought about this, Susanne. So, hats off to you.
Yes, thank you very much, Mallika. And now I want to turn the table, because I know for our members, we promised to do a fireside chat between both of us. And so I wanted to ask you as well lots of questions, Mallika. So if I could ask you first about, what are your top tips for startups and how can they prepare for their fundraising journey?
Okay. I basically think that, so as I said, I see a lot of deal flow and those short presentations. And I think the basic mistakes I think people make are not spending too much time practicing the presentation and not improving their own presentation skills. And now you're all stuck in the Zoom format. So actually a lot of your personality is stripped away, your body language is stripped away. The little banter a presenter could have with the people she's presenting to beforehand, that's gone away. So it's just like that 3 or 4 minutes or 7 minutes is everything. So firstly, just make sure the deck is professionally presented. So maybe 16-point format. Us investors tend to be a bit older, not younger, so that we can read the thing. And then introduce yourself. Like, people just they will go into what their startup does, and they won't introduce themselves. So I want to know who the person is. And it's not listing off qualifications, but like what brought you to this in a little bit. So just share something of yourself, so that there's that, why this person? Because the ideas are mostly all good. And then the third thing with the idea is basically you have a storytelling way of presenting, and you have a technical data way of presenting. And what I see is, and you need to have both. So you need to tell a story, but using the technical data, saying, oh, this is our market, this is the size we try and capture, these are our fundamental, these are what we are projecting as growth and etc. This is our valuation, this is our pre-money, post-money, all that. But there's also the story of with music and what is the problem we're trying to solve? How are we solving it? And I think I see people getting too much into either bucket. Like, people go too technical, or people go too much into the story where you're just listening to this music and it's lovely, but you don't really learn about anything. So I would say, try and get that in a good spot where you tell your story, but you also tell the technical data. No one can read graphs in real time. You might be so used to seeing your numbers, you can just see where the numbers are moving. But like, seriously, if you have more than 4 or 5 numbers on a table, I just can't interpret it within 30 seconds. So have the numbers there, or have them, in some way presentable, and just make sure, like, I see all kinds of ways of valuing companies, and lots of things, CapEx, OpEx, this and that. So just assume people don't know what they're talking about, and and bring out the definitions. The other thing is you're going to get completely contradicting opinions on everything. So you can say, "This, I'm going to use white slides," and someone will say, "Oh no, use black slides," and you'll change to black slides, and then someone else will say, "Oh, you should use white slides." So just about everything, and I can see the frustration building in the startups when we were on the coaching days, and one person on the table is saying something, but I think the thing is to take it on as a mosaic. Like, it is your startup, it is your presentation, but you have to take on these contradicting views. And that way is to niche down into who your angel investor is going to be. I think there's a big problem in terms of prom king mentality with investors. So I know some of the famous kind of investors, people who they've had good exits, their name is kind of known in the marketplace. They just get hundreds, they're just swamped by deal flow, and people are cold calling them. So they're kind of like the prom king or prom queen in an American high school. Everyone wants to date them. But on the side, there are people with deep expertise who have a few million or a few 100,000 who would be extremely good investors for you, extremely good people who could give you time and advice. So I would say look for those people, because the star people, maybe you want just one, but maybe they can give you 5 minutes of their time, and there's so much competition. So that's something I would say to keep in mind. And also just hustle. Everyone says hustle, but hustle nicely. Like if you're, there is an element of cold calling, but also just try and be a decent person about it, because that's the number one thing I will hear from high net worth and angel investors is they swap stories on how arrogant a startup founder was or how rude they were. So just try not to be in that category. So that's what I would say.
Yes, wonderful tips. So very, very important to keep this in mind. I think that's very, very thoughtful. And I also wanted to ask you, because of course you've been part of our selection days over the last few years, our coaching days, and of course, without mentioning any names, but have there been any things? Any themes from startup founders which you have seen as mistakes? Any things which people should avoid doing, so that anybody on our call can learn from others today?
Okay, I think one thing is don't ever embarrass the investors. I've seen that where people just ask put the investor on, because they're usually trying to help you. Like I think most people who are giving startups time, they love the space, they love fintech, they like startups. They're not there to heckle you. So don't embarrass them, or don't react to them, because they're just giving you their own viewpoint. The other thing I think with startups, with fintechs, I don't know what others, is they're either like super into the financial services ecosystem, where some sort of niche systematic trading or database that very few people understand. Or it's some sort of generic retail play where it's like, there's this app that'll help you save money, which just about anyone can understand. And so just know which bucket you're in, and maybe the retail one needs to very quickly start to say why they're special and why they are unique. And the ones that are very niche, because there are a lot of these niche markets. And Susanne, as you know, the world is our oyster in terms of fintech. Explain the niche to them, because I see these presentations where they start off and I can see, like, I have no idea what they're talking about, or I can see another investor knows exactly what they're talking about. And then sometimes it happens, I'm like, okay, oh yeah, that makes total sense to me. And I can see everyone else has a glazed look on their eyes, because I understand, because I've had a job in that market or not had a job in that area. So I would say, like, make sure it's very generic. The other thing is the appendix. The appendix is your friend. Like, just any data you want, like don't show your homework. Like, I think we're all trained, we go through schools and we're like supposed to show our work. Like, how hard did we work? We worked 10 hours. And that people try and push that into slides. Like, oh, there's all this data, there's all this stuff. But push all that sort of the homework you've done into the appendix, and just keep the actual presentation very clean. If someone asks questions, then please just go ahead. The other thing is, like, just be very firm. Like, people will ask you for evaluation, pre-money, post-money. Just be. And if you don't want to give it publicly, don't give it. Just say, I can talk to you after that. Like, don't get hold firm on what you want. And people will it'll take them a long time to get to what they're raising. So I think immediately, like say you're trying to raise, 2 million, someone who's going to give you 10,000, that's probably not the right investor for you. So just immediately tell them what you're looking for, and then ask for referrals, because everyone will know someone else. And I think in some ways you just have to play to your niche. Like, sometimes someone very corporate comes on, and then us startup people are kind of, we're much more casual, and you can see they're just like, oh, why isn't this progressing in an orderly manner? So I think it's just try and just know that all the investors out there's only a few that are good for you, and the rest will have good things to say, but they might not be the ideal one for you. So those are some things I can think of. And also just keep, I would say, like, yes, you have to raise money, yes, you have to do a good presentation, but from what I've seen, the people are actually there getting the customers, building the business. You can have the crappiest presentation and slide deck, but if you have the cash flows coming in, people will be jumping on you. So that's also to be taken in mind. Like, actually have the show traction. I think when people see traction, they immediately pay attention.
I think that's very good advice, Mallika. So I think the bottom line, of course, is key, So anybody, we always say, any of our startups who are revenue generating, make a big deal out of it, because not everybody is revenue generating. Of course, at later stage, when people are profitable, of course, it puts you in a different category altogether. Mm-hmm. But at the moment, it's between not yet revenue generating or revenue generating. And like you said, the slide decks, they have to be, almost we say, the two types of slide decks. One is for emailing it out to investors, and one is for presenting live. And those presenting live slide decks should be, like Mallika explained, a high font or larger font, easy to read on a laptop, on a PC screen. And the appendix is your friend. I think that's a really good point. So make sure that all the data, the financials you've got in the appendix, so when during the Q&A, when you need to respond to that, you can pick it out from there. You don't have to know anything by heart, but it's not part of your main story, because your main story might only be, 5 minutes long or 7 minutes or 10 minutes long. Mm-hmm. So very good advice, Mallika. And I just saw we've got questions coming in. So I wanted just to invite all our guests today, please come forward, write us your questions in the Q&A box, which you've got. We will come to that a little bit later when we start taking the first questions which we have received. So thank you already to Masego. We see your question coming in. We will come to that in a bit. So now, if I can ask Mallika, you as an investor, of course, you look at investment opportunities, lots of them. And if you have got a few good ones left, mm-hmm. You need to make a choice between the best of the best. Yep. How do you do that? What are the things which trigger you to say yes, or what would trigger you to say no?
I guess overall it's just the likelihood of success, because I'd rather something that is 19% successful, I'd rather get a 2x on it than something that's a 1% success rate but has 100. I can get 1,000x. I will pick the 2x, even though someone said, oh, you should pick the 1,000x. But I was like, oh, I have a higher probability of success. So I think that probability of success is what drives all investors. The other thing is just the niche and understanding. I think from what I hear from angel investors, they always want that there's a pain point, and they see someone else solving the pain point, they pay attention. So definitely, be very clear on the pain point you're solving. That's what I would say. And then in terms of valuation, I think there's this, and again, I have my own views on it, but don't be too greedy and don't be too underconfident. There's got to be that, you can't have been going for 1 month and have a £3 million valuation, unless you have some IP or, it's just make sure, just be reasonable about it, and, talk to people before being reasonable, before giving that out. because obviously like the best opportunities, if you're not buying it at the right price, people are just going to say no. I think another thing that I would look for, and what I see other networks looking for is effort. How much effort am I going to be having to put into this? Because, you know, people will take board seats, they might just love the space and want to advise the entrepreneur and help them. But a lot of investors just, they want to give you the money. They want to co-invest with their friends or people they trust, like yourself, Susanne. But then they just want to stay out of it. And but if they feel they have this thing is going to take too much work, it needs too much advisory, then they're going to step back. So remember, you're not just asking for their money, you're also asking for their time. And so the money they might be willing to give you, but the time they might want to hold back on. So just keep those two things in mind.
Very good. Very good, Mallika. But I wanted to ask you, the question Mallika had, wanted to ask you is about Silicon Valley and how it compares against London.
Right.
Because you worked in both locations. How would you contrast and compare both?
Yeah. So basically, as I said, I grew up in Palo Alto. I went to Stanford, and I've maintained strong links to Stanford. I've been president of the Stanford Club of Great Britain. I'm part of the Stanford Angels Network. So I no longer live there, but I've maintained connections. And the one thing I've noticed, having had that experience, is that people outside of Silicon Valley think of it as this magical place with all this money. And yes, it has all this money, but it also has all this competition. And I really think London and some of these European cities like Malta, are really good places to grow good, sustainable businesses. Silicon Valley has, as I said, there's so much talent, but it's extremely expensive. And to get the time, it is, it's just, I think people think of it as this utopia, but it isn't. It's just a different type of, it's a different type of environment. So I would say definitely don't do that. I think London, as you mentioned, Susanne, that Silicon Valley had this networking element to it, this ease of networking. But I think people like you have built that in London. You have Level 39 and yourself and other ecosystems, and the internet has made that much easier. So Silicon Valley, I think the thing is, like, I remember when I was looking for funding many years ago, like I literally emailed one person I knew. That person farmed me out to 3 people. So by in 1 week, I'd had like 20, 30 meetings, because everyone will give you 20 minutes or half an hour just to hear your idea. But you also have to know that people are, they want to know what the market looks like. So you're giving them information. But I think that can happen in London nowadays. So I would say, like, don't beat yourself up because you're not sitting in Palo Alto. Like, I think other places are just as viable. And those unicorns you hear of, there's always some advantage those people had that you might not know about looking at it. So and I think the good old days of, someone come, and as you said, the Berkeley Stanford thing, the good old days of like rolling out of Berkeley or Stanford with a good idea and then just making a lot of money. You'll get funding, definitely, but making a lot of money out of that, I think it's very different now, because it's all very social media based, and there's this element of luck that is in Silicon Valley. So I have friends who've done beautiful startups, very complicated, and made no money, and I've had friends who've literally hit the jackpot at their first startup with a very simple idea. So I think there's this huge element of luck that you can't predict. So that's why I kind of like the finance area, because yeah. So that would be my.
You're right. Important to keep in mind. An element of luck as well, in anybody's career, in anybody's journey. And Mallika, you of course also wrote a wonderful book on investing. And as an entrepreneur, it's important, I think, to put yourself into the shoes of the investor, into the mindset of the investor. But can you tell us about your book, and also about how entrepreneurs can learn how investors think?
Right. So I think the first mistake people make is they think that people with money have all the answers and are very happy people. But what I've seen is actually, and this is my, my background is seeing people who started companies and then had exits, and now they're 10, 15 years on from that exit, and maybe they've done some other company or whatever. But actually, the problem for them money-wise starts when they exit, because they suddenly have this money that they now need to invest, and they've climbed the mountain, they've reached the top of Everest, and they're like, oh my God. And this could be, say, it could be $1 million, it could be $1 billion. It's the same problem. Like, how do I now preserve it? The second, I think there's this ego element to it as well, where they want to be seen as by their peers as a good investor. So they will, so that's why people follow trends a lot. So you might have a really good idea for something that's very, very useful, but it's not trendy right now. So you might not get the funding. So basically what my book deals with is, it's basically how the best invest, make confident decisions like the investing superstars. And that's directed directly at entrepreneurs who now who've done well and now want to deploy their capital, because they have no idea how to invest well and how to make confident decisions. They can make very good bets operationally within their ecosystem that they know, whether it's fintech or software services or whatever, but they don't know what. And basically what I concentrate on is the investor brain. So our human brain, hates pain and loves being greedy as well. But we've got this lizard brain that has like this fight or flight response. And then we have a very emotional side that we cannot control. And everyone goes around thinking we're making these decisions from our neocortex or our logical brain, but actually a lot of our decisions come from fear or emotion, and we can't even control that. So just remember that when you're talking to investors, because they might make the bet on you because you're from their same city, from wherever. There might be they see something of themselves in you, and it might not be a logical decision. So try and keep that in mind. And then they have a huge aversion to this, and I think we'll get into hopefully what venture capitalists and private equity investors might be looking for. For angels, I think this is very personal, and it's their personal money. Like when they write you the check, they're going to see the debit in their bank account. So it's very, very personal, versus if you're a career kind of venture capitalist, you're writing the check, but the check is from your corporate bank account, so it doesn't hurt in that way. So just remember who you're dealing with. So remember how people are wired, what their incentives are, and they're probably not making logical decisions. They're probably like, okay, I like this, I don't like that, and they talk about instinct, and I'm not sure that exists. They say, oh, this investor has this instinct and venture capital, but I think they just, I don't think there's this magic. I think there's an element of being very smart and very hardworking, but also of luck. So that's something I would say keep in mind in terms of dealing with the high net worth. And just remember they're human beings, and they were probably once where you were, and they're going to judge you based on that because they were more hardworking or less hardworking or whatever it is. So people bring their personality issues, good and bad, to the process. Okay, that's
fantastic, Mallika.
I would think that's
really helpful. Fantastic. Yes, I've seen we've got lots of questions coming in. So I just look at them just to see which ones we can answer right away. So we've got one question which says, would you say there's an advantage to go through an incubator program, such as the Y Combinator, in the Silicon Valley, before going to angel investors? Or do you think it's an either or question? I can maybe answer it from a London point of view, because in London we also have got lots of good accelerators and incubators, you could say. And the Y Combinator, of course, is one of the best ones in the world as well. But I would say it depends on, number one, if you as a startup have to give equity away or not. Some accelerators in the past, they took 8% equity. I don't know how much the Y Combinator does, but that's a big decision. Is it a big decision? Do you want to take almost 10% of your equity away to an accelerator? If you do, they have to deliver lots of value to you, because otherwise you dilute your equity stake from the beginning. So that's one thing. The other thing is, does the incubator help you shape your business, challenge your assumptions? Is it helpful in terms of finding new customers, helping you in your business development? So one very good accelerator in London is the one by Accenture. Accenture, it's called the FinTech Accelerator by Accenture. It's focused on business-to-business fintech companies. So any B2B fintech companies who want to get exposure and want to sell into banking. That's a fantastic accelerator to be part of. And it doesn't cost you anything. So that's the other advantage. There's no fees. You don't have to pay any equity. You just benefit for 3 months by being introduced by the partners in Accenture to all these potential clients, which Accenture works with. So they've got these warm connections and can introduce you nicely to potential clients. And so I would say, therefore, it depends. There's no right or wrong answer. It depends. Is the incubator a good one? And is it worth your money, worth your equity and your while to do it? And so definitely check out other companies who went through the incubator to get their feedback. This would be my thoughts on this question. I don't know, maybe Mallika, would you like to add any of your thoughts?
I think, again, for example, I think FinTech Circle has a very fair proposition, which is, again, that equity thing, are they incentivized? Are they, I think that something like a Y Combinator makes you look very polished and gets you in front of certain investors. But I think they might have it's called spray and pray. Like you just spray your deck out to as many people, and then you pray that something comes back, and maybe people will click on the Y Combinator link. But there are quite a few out there, and I think investors are looking for a lot more curation. And I think if you already have some sort of existing network, I would just say, get some help, but it's again, it's up to you. Like if you're 20 years old and you have just absolutely no other way of doing it, then maybe it makes sense. But who's already in your network that can help you? I wouldn't automatically think that this is the best thing, because startup founders, they start to measure their success by how much money they've raised. They'll be like, I've raised this much money, but I'm like, that's not success, right? The success is the exit or the IPO or the number of customers or revenue you have. It's not. So just keep that in mind. At the end of the day, you want revenues and customers. It's not about raising money.
Good, Mallika. And then we've got another question coming in, which says, if you are a non-technical founder and have an idea, what would you look for to invest in that? So would it be better to have a technical co-founder, or is it okay to outsource the technology build, to somebody else? And that's a very important question. We get lots of times, from entrepreneurs, often the CEOs, who are the non-technical founders, but they would ideally need a tech partner, a co-founder, to work with them and to start the business together. But in some cases, in some cases, you find people know both. That of course it's ideal that they can manage tech teams very well. But I would say if you are basically the functional, the business head, but you need a technology person next to you, it is often not easy to find one, especially in our environment at the moment with the pandemic, because normally in order to find your co-founders, it's all about networking. It's about going out, meeting other entrepreneurs, sharing your vision, your passion for certain pain points, how to solve them, and see who else has got the same ideas and similar. It gets inspired by what you have to share, and then to see if you click. That's very important, if you both get along well. Because in order to have somebody as a co-founder of your business, one of the key things is that your relationship has to be very, very strong, because you have to go through ups and downs together, and nothing is worse than founder conflict. And we've seen that as well among when investors, look at startups evolving over time, some go through founders conflict, and that's something which is very, very exhausting. I mean, for the founders themselves, but it's also very difficult for the investors, because it could actually come to the end of the business. If founders completely disagree, they don't want to work with each other anymore, it could mean the end of your startup. So very important to choose, whom you want to co-found a business with. But if you need a tech founder, I would say it's, networking is the best way of finding it, all via referrals, via your friendship base, but also via accelerator, incubator programs. They might also be able to help to do that. And of course, the third option would be to outsource. And I've seen that, from other companies who had no tech founder, that they initially outsourced it to a tech software company, but with the goal to insource it as soon as possible. Because if you build up IP, the key thing is the IP has to be in-house to be valued by investors. And if everything is outsourced and can be therefore sold to other clients, your IP is not protected. So it's just a short-term solution, but long-term you have to have an IT team in-house. And now, if I know that we are almost running out of time, so we've got a few minutes left. So maybe if I can ask, let's see, we have answered, I think, all the questions which came in, I believe, from our audience, from our members so far. And but let me just see if I wanted to ask you one other question, Mallika, because we spoke about, we often speak about the funding ladder. So when an entrepreneur starts out, first you go to your family and friends, ask them for money. If family and friends, and also grants, free money, of course, is government grants. But if that runs out, then you come to our angel network, to angel investors, to get angel funding. At some stage, you have to go to the next level up, which is a venture capital funds, VCs. Then the last stage would be probably private equity. And each of those investor types have got different requirements and different ways of choosing and making investments. And can you explain the difference to our members, please?
Okay. I think it's all about remembering what the incentive is that they're meeting you for or looking at your deck for. In terms of angel investors, they're usually just, they want to make a return. They want to look, they want to look good to their co-investors and their friends. Obviously, we're human, so we have this ego, but they're the most likely to help you. I think venture capitalists, remember that it's not their money. It's usually raised from pension funds. So what are they going to be able to raise from the pension funds? So what are the what are the themes? And that's why you see these kind of social media, climate change, everyone is jumping on a certain bandwagon because that's what the pension funds are doling out to. And venture capitalists, the less senior ones, they have check boxes to finish. Like they need to meet with X number of companies this week. They need to do X number of deals this year. So remember, you're one of their statistics. Where angels are just, they're not going to waste their time talking to you unless they're actually interested in you. Private equity, I think, has been very interesting in our space. Because traditionally, private equity looked at very large companies, logistical companies, big leverage buyouts. But what I've seen in Silicon Valley is that you have these very, the big names in private equity. They have Silicon Valley offices now. And I don't know, this might be true in the London market too, where they just want a small stake of like Uber or Airbnb. And it doesn't make any sense because, that's not their thing, but they want to show off to their investors, hey, we are an Uber, we are an Airbnb. So they will overpay in order to do that because they want to save. So they might have like, say, 100 billion under management. It's worth it to them to have 1 billion sort of overpaying for everything, with a crazy valuation, just so they can say they're in this interesting niche. So again, with private equity, their biggest problem is not deal flow. Their biggest problem is raising capital. So just remember the incentives for people who are going up the food chain. And it's always best to deal with, I call it the chief chimp. In any situation, the highest person you can reach. So the venture capital firm, talk to the founder. FinTech Circle, talk to Susanne. The private equity firm, talk to the managing partner. The minute you start to talk to people lower down the food chain, they're worried about their bonus and their salary and their promotion, which might not be the thing, versus the founders usually have the cleanest mindset of like, okay, how can I help the startup get up and going? That's my 2 cents.
Fantastic, Mallika.
And Susanne, we haven't asked you any questions. So I know you go all around the world, and in the UK, we have the system of SEIS and EIS, which the government has incentivized high net worths to invest in startups. Since you have a very, very global take on this, what are some other initiatives and learnings that you think people should have? What are some successful initiatives to help build a startup ecosystem?
Yes, I mean, I would say the SCAS and EAS tax schemes in the UK are excellent. So any entrepreneur, and there are entrepreneurs who actually come to London or come to the UK just to benefit from those 2 schemes. So just want to summarize them for you as a founder of a company. It basically means that you can attract investors, angel investors, and give them a certain security when they invest in your startup, because as an SCS investment, which can be up to £150,000, for you as a startup, the investors get a 50% tax incentive to invest, but it's only possible when you're in the first 2 years of your life, basically, and it protects a downside, because if the company would go bust, they can get a loss relief. So they've got this protection of the downside because of the tax relief and the loss relief, but upside is unlimited. And for an EIS investment, the tax relief is about 30% for investors. And again, the downside is protected. I mean, not completely, but about I think you get about 23% loss relief. So you have got better chances overall in your portfolio to make money in the UK with those tax incentives. And I have been and talked to many other governments and countries, but no other government has put such a generous tax regime in place. So I'm not aware of anybody else, that's one reason why the UK is often seen as a startup nation, and why we have seen lots of international founders come to the UK to raise funding, because they want to tap into this tax relief. But I think what we've seen in other countries doing very well is also building up a hub, building up fintech hubs, and that happens across Europe, happens in Asia, in Latin America, in the States. So we've got fintech hubs emerging where governments and the local communities and the banks start to work closer together, which I think is a critical success factor to make a successful ecosystem emerging, where startups can find local customers, local employees, local investors, which then is a good basis to expand internationally. But that's what I think we can see globally. Those hubs then work together, and we call them fintech bridges. So there has been the first fintech bridge, for example, was launched between the UK government and Singapore a few years ago. And there are other fintech bridges which basically help you when you are a regulated startup in one jurisdiction, that you could go to another country and get welcomed with more open arms by their regulators, because they have got an agreement with the UK regulator, the FCA, for example. So those fintech bridges also do exist and also make it easier to expand.
Yes, Susanne, you have such a good knowledge of this ecosystem and optimizing. It's I would come straight to you for these questions. And now going to the C word, which we all try and avoid. But how's COVID changed investor sentiment? Is there more or less deal flow in fintech? Because they talk about digitization, but I don't know which way it's going. Are the ticket sizes changing? And is there any sort of is there some area of fintech you think might do very well coming out of this pandemic?
Yeah, I would say what we have seen initially, since April, May, June, so in the beginning of the pandemic, was that most investors had no headspace to invest, because everybody was worried, everybody was concerned about their families, their health, the pandemic overall. So we saw a huge pause in the market, almost just to digest what goes on now in our world, and people pausing and wait and see mentality. and then starting to realize we need to help our existing investments to make it through this crisis. So we've seen lots of people then investing into their existing portfolio companies, providing them with more cash flow to water, the economic recession which we are going through. And I think only now, after the summer, we've seen again more of an upturn where people realize that this might be the new normal. That we are living in and out, of this pandemic for a while, until a vaccination has been developed and has been made available, globally. So this might be the normal at the moment, maybe for the next year or two. And therefore, people want, of course, to invest because fintech is a future industry, it's a future sector with huge growth rates. So it's an investment people want to be in, they want to have exposure to.
Thanks, Susanne. And one last question for you. I keep hearing that by 2030, financial services, asset management, banking is going to look completely different than it is in 2020. And I think you're one of those people who's going to see and be driving that change. What do you think are some of the obvious changes that you're seeing that people outside of your network are not seeing in terms of getting to 2030 and upending this sector?
Yeah, I would say one of the biggest changes I think we will see will be so-called embedded finance. And embedded finance basically means that your financial services are part of something else. So when you think about Uber, taking the Uber car, you just leave the car and you've paid. When you think about in China, WeChat, the WeChat app, which is the same thing as if you would combine Twitter, Facebook, different social media channels and payment methods together in one social media app. That's what more than 1 billion people use in China. And I think will come to us as well. I don't know if WhatsApp will be the solution or something else, but a social media app which allows you to pay, which allows you to invest, which allows you to save money. So it's part of our daily lives, but it's not anymore a bank. It's not anymore a bank which provides the services to us, but it's a social media solution. That's, I think, what we are moving towards. And it brings, of course, risks in terms of privacy, in terms of oversharing of information, but also opportunities. And I think for those companies who are willing to explore and experiment. And I think the last thing I would say is that the collaboration between fintech startups and banks will become better. In the last few years, we've seen initially that banks and startups started to work together, but it was never at a big scale yet. We've never seen that implemented at large scale, but now in the next few years, it becomes almost a reality that the fintech sector has got fantastic solutions, which can be licensed by banks. And so I expect much more partnerships, much more collaboration, which will benefit, both sides to take place.
Okay, that's very interesting, Susanne. So thank you so much.
Yes. Thank you, Mallika. And I would like to thank all our audience, all our members for joining us today. I would like to thank Mallika for having this wonderful fireside chat. We thought it would be interesting just to have a talk, between both of us, talking about all the topics which hopefully are really relevant to all our founders here today. And if you've got any more questions, please feel free to get in touch on LinkedIn with either Mallika or myself. And we will follow up in an email as well. Just a summary again, the membership benefits which you've got, just to make sure that you can use them all. And one of the key things, of course, is make sure that you leverage our FINTECH Circle network to share your story in public globally. So you've got, all of you can share a blog post on our FINTECH Circle website and across all our social media channels. So submit this, please, to our marketing manager, and then we can get it published. But there are lots of other benefits we will share as well, to summarize in an email. But thank you so much for attending and for joining us. And I thank you, Mallika, for joining us. And I wish you all a lovely day. Speak
Thank you so much.
Bye-bye.
Bye-bye.
Bye-bye.